Today we're jumping into Jeremy Siegel's classic book, The Future for Investors. Honestly, if you're serious about long-term strategy, this book is an absolute game changer. We're going to unpack the core ideas that really separate the winning investors from, well, everyone else.
So to really get what Siegel is talking about, let me paint a picture for you. Imagine you started your investing journey during one of the best times in stock market history. I mean, everything you touch turns to gold. You feel like a genius, right? But what happens when that incredible party starts to wind down?
And what a party it was. Just get a load of this number. Between 1981 and 2000, the Dow Jones shot up by 1,100%. And that's before you even factor in dividends. A number like that, it does more than just make you money. It completely rewires your brain and shapes how an entire generation thinks about the market.
And look, this wasn't some slow and steady climb. It was like two massive back-to-back rocket ships. The Dow started below 1,000 in 81, and by the year 2000, it was screaming past 11,000. When you live through that kind of insane growth, it's really easy to start believing that stocks only go one way, up.
And that, right there, leads us to the most important question of all. When all you've known are these incredible returns, it creates this powerful bias. You start ignoring the risks, thinking you've got it all figured out. But can the party really go on forever? This is exactly where Jeremy Siegel's wisdom becomes so critical.
Okay, so this is where we really need to pay attention. Siegel points out several hidden dangers, he calls them traps, that can completely wreck your portfolio, even if you've been investing for years. We're going to focus on the three biggest ones he warns us about.
First on the list is something called the growth trap. And we've all seen this, right? Some hot new company comes out of nowhere, everyone's talking about it, and we all get swept up in the excitement. The problem? So does everybody else. The stock price gets bid up to these crazy, unsustainable levels, and you end up paying way too much for promises of future growth that a lot of the time just never happen.
And then there's the bubble trap, which is even more dangerous. Think of this as the growth trap on steroids. This is when that fear of missing out, FOMO, kicks in, and investors just pour money into an entire sector. The dot-com bubble is the perfect example. Valuations get totally disconnected from reality, and when that bubble finally pops, the crash is just devastating.
Siegel is brutally honest about this stuff. He says for every huge IPO success story you hear about on the news, there are just tons of others that completely flame out. Chasing that next big thing is a really high-risk game, and the odds are pretty much stacked against you from the start.
And it's not just about market psychology. Siegel points to this other huge challenge coming our way, the age wave. Basically, as the massive baby boomer generation retires, the whole dynamic of the market starts to shift. You're going to have way more people selling their assets to live on than you'll have younger people buying them. This is a fundamental demographic shift that could really put the brakes on market returns for a long, long time.
So, with all these traps and long-term challenges, what are we supposed to do? Well, this is where Siegel gives us the solution. He lays out this core philosophy, a strategy that's backed by decades of data and built not on hype, but on principles that have always worked. And here it is, the secret sauce, in 3 simple steps. First, you hunt for great companies that are actually undervalued. Second, you make steady dividend income a huge priority. And third, and this is the most important part, you take those dividends and you reinvest them, letting the absolute magic of compounding do its thing over the years. This requires a complete shift in how you think. It's about tuning out all that short-term noise, the chatter about quick stock pops and market hype. Instead, you focus on the total return, which includes those crucial dividends. It's not about chasing the new, it's about owning the true. Companies with solid, proven fundamentals.
Look, if you only remember one thing from all of this, let it be this quote right here. The real power isn't just in a stock's price going up, as Siegel says, it's the steady, reinvested income from dividends that gives the real winning stocks their edge over the long haul. It's just that simple.
Okay, so let's go back to that personal story we started with. How does knowing all of this actually change what an investor does? Well, the transformation can be pretty stunning.
So take a look at this before portfolio. There's a solid 60% base, which is good, but a massive 40% is tied up in pure speculation, chasing those high-growth stocks. That is a huge chunk of the portfolio that's just totally exposed to the very traps Siegel warns us about.
And now look at the after. It's a completely different picture. The core long-term holdings now make up 95% of the entire portfolio. In speculation, It's been cut way down to just 5%. That's just enough to have a little fun, but it's not going to sink the whole ship. This is what it looks like when you actually apply Siegel's principles.
All right, let's wrap this up and boil it all down into the key lessons that you can apply to your own financial future. These are the big ideas that will serve you well, no matter what the market is doing on any given day.
So here they are. First, always be careful about overpaying for hype. Second, remember that total return, dividends included, is the name of the game. Third, make reinvested dividends your secret weapon for growth. Fourth, build your foundation on quality companies that you can buy at a fair price. And last but not least, keep the gambling and the risky bets to a tiny sliver of your portfolio.
And what's really important to remember is that this disciplined strategy doesn't mean you have to be pessimistic. Not at all. Siegel himself is incredibly optimistic about the future. His whole approach is just about navigating that future wisely, so you're set up to actually benefit from all that long-term growth without getting caught in the traps along the way. So that leaves us with one last big question for you to think about. When you look at your own investments, at your own strategy, are you really set up to avoid these traps? Are you positioned to capture the real opportunities of the future? Is your portfolio truly ready for whatever comes next?